Hey everyone, welcome to my channel. My name is Anand and I am a full-time software engineer with an all-time passion for value investing. In the last video, I tried to explain the power of compounding and stressed the importance of time. If you haven't watched that video, you can watch it here. In this video, I am going to explain the importance of the rate of return on the results of compounding. Let's imagine your friend invested $10,000 for 20 years in the S&P 500, which has an average annual return of 10% during this period. The S&P 500 is a passive investment vehicle that tracks a basket of 500 large cap US stocks. It is a low cost investment with an average expense ratio of less than 0.1%. At the same time, you decided to put the same amount of money in an actively managed mutual fund. Actively managed mutual funds are managed by professional investment managers who try to pick stocks that will outperform the market. However, they typically have higher fees than passive investment, and in this case, the fee is 2%. Studies have shown that most active investors fail to beat the market over the long term. This is because it is very difficult to consistently pick stocks that will outperform the market. And even if you do manage to pick a few winners, it is likely that you will also pick some losers. Even then, let's say you are lucky and your chosen active fund does beat the index and returns 11% compounded over the same time. However, because of the 2% management fee every year, it is obvious that you would make less than your friend, as you would be earning 11 minus 2, that is 9%, while your friend would earn close to 10%. Now the big question. Do you know how much extra money your friend would make because of this just 1% outperformance? We now go to Let's Value Invest and use its compound interest calculator to know the answer. We will enter 10,000 as initial investment, no monthly contribution, and we are investing for 20 years. Let's put the rate of return as 10%, and since we know our friend made an extra 1%, we'll use this as variance to calculate the outperformance. As it is evident from this table that not only would you be making $11,000 less than your friend, but you would also be paying a total of $11,000 plus $13,000, which is $24,000 in total to your active fund manager in fees alone. See what a mere 1% can do to your finances. And imagine the scenario when your active fund doesn't beat the index. Another mental model to think about this situation is to imagine that you are able to dedicate yourself to being disciplined and learning about investments and businesses with a curious mind. You also invest the same amount of money on the side and are able to just beat the market by 1% over a 20-year period. I know that's a lot of assumptions to make about yourself, but for a moment, imagine that you are able to achieve that. This is a challenging task, no doubt, but it is possible if you are willing to put in the hard work. By learning about investments and businesses, you can develop the skills and knowledge you need to make informed investment decisions. And by being disciplined, you can stay focused on your goals and avoid making rash decisions. If you are able to achieve this, then you can think that you have been rewarded with an extra $11,000. This is because the power of compounding works in your favor when you are able to consistently beat the market. Over time, even small differences in returns can lead to significant differences in wealth. What's more, if you earned another extra percent, that is 12%, the money would increase to $29,000. And if you're able to make, say, 15%, you would make an awesome extra $96,000. This is an example of how discipline and learning can help you achieve your financial goals. If you are willing to put in the work, you can be rewarded for your efforts. The potential to earn higher returns by picking stocks on your own can be a powerful incentive, and people are naturally pulled into buying stocks on their own. But like I mentioned in my previous video, most of us also get into the trap of taking a higher risk in order to earn better returns and thereby end up earning even less than the index itself. I therefore generally take a conservative approach to my investment journey. I invest in diversified ETFs such as VOO and QQQ on a weekly basis. These ETFs track the S&P 500 and Nasdaq 100 indexes respectively, which are two of the most popular stock market indices. By investing in these ETFs, I am essentially investing in a basket of stocks, which helps to reduce my risk. Additionally, in order to satisfy my value investing self, I also focus on low risk, high return investments, and when I do see a compelling opportunity, I pounce on it, hoping I would be able to make a little bit over the index, which would compound over the long term and generate some extra wealth for me. I do believe that this is a sustainable and achievable approach to investing. It allows me to take advantage of the power of compounding while minimizing my risk. Well, that's all I wanted to cover in this video. What is your approach to investing? In order to make extra returns, have you ever made a risky investment that resulted in a regret later? Please let me know by leaving a comment below. As I have continued to learn about value investing, I have also used my IT development background to build a product called Let's Value Invest. The link is given in the description below. I have built this web-based product with value investing in mind, and it can be used to analyze stocks, look at historical data, run valuations to find intrinsic values, and more. And it is currently free to use. So please feel free to try it out and give me your feedback. I do plan to add new features to the product as I keep learning, and your feedback would be extremely valuable to me in this regard. If you would like to be part of my journey to learn, invest, and learn, then I also encourage you to subscribe to my channel. Thanks for watching. I hope you found this video helpful. I'll see you next time.